equity markets have remained volatile this year, even as the markets have run up quite a bit recently. And this makes it the perfect time to understand what kind of strategies should investors adopt to get the most out of their portfolio. What should be the ideal portfolio allocation to the debt and the equity mutual funds? And should you go heavy on the equities or increase your exposure to the debt? Let's answer all these questions and welcome on board Arnav Pandya, who is the founder at Moneyeduschool. Hi, a very good afternoon, a very good evening, Arnav, and thank you so much for giving us your time on ET Now. The first question, let's get started, because today we have seen the Nifty hitting its all-time high levels for the year 2023, sitting at year high levels and surpassed that 18,400 mark as well. And recently, we are seeing that the FII buying in the Indian markets is making a comeback. What's the outlook? Because now many people try to catch the train. Maybe they must have missed the buzz from the March lows. But what's your understanding on the equity markets? Because there's still a lot of headroom left when it comes to the recovery for the mid and the small cap or end of the market. So what should the equity investors or the probable investors looking in the equity market should do at this point in time?
Good evening. See, it depends on when you are looking at the equity markets, because that frames the entire environment for the investors. For example, you have seen some good days or weeks for the equity markets, because you see a lot of these FIIs flow coming in. Some of the corporate results have been good. So it looks as if that everything is well in the market. Maybe a couple of weeks later, you find that suddenly the mood has darkened and things are not working out, and there is an air of pessimism all around. But see, these are the basic features of equity markets, and any investor who's looking to build a long-term portfolio, what they need to do is not worry about all these short-term trends, but focus on how they are meeting their asset allocation needs. So, for example, if you have decided on, say, a 40 to 45% exposure to equities, say 30% to debt, another 10-15% to gold, another a bit to real estate, your focus should be on ensuring that this asset allocation is present in your portfolio, because two things can happen. One is that due to market movements, your existing portfolio gets, the balance gets changed because of the way the prices move. And the second thing is that often you have more money to invest, or you pulled out some money for some specific needs, wherein again you need to rebalance it. So this aspect of how the market is looking, what you need to expect as an equity investor, you got to understand one thing, that markets will go through phases of high optimism and pessimism, and the outlook can change very quickly, but that point itself should not affect how you are allocating money to equities. Once you go with that principle, then you know that whatever allocation you've decided, how are you actually going to go about it, specifically when you're using the mutual fund.
Okay, so that's the advice coming in on the equity side of the investment. But Arnav, what about the debt side of the investment? Because we are seeing many factors at play. There are so many concerns in the global markets regarding the rates. But in India, we have seen the RBI taking a pause in the recent MPC meet. So what are the factors that you are picking up that could be at play for the debt market going ahead? And how should an investor place their bets when it comes to the debt side?
So on the debt side, what we've seen over the last 1.5 years has been that rates have been rising, but it is now very clear that we are very near the peak of the rate hike cycle. What this effectively means is that the RBI is already in a pause mode, which means that there is no reason for them to immediately raise rates. So in that sense, investors who have been holding back on their debt investments, thinking that more rate hikes will come, for them, at least there is a very clear indication that you should start allocating money to debt and not just wait for even higher rates. The second thing here is that even the outlook ahead is not as clear as it might look from the sidelines, because of the fact that the main factor driving inflation in India is usually food prices. And there is a big risk to this event because of the fact that there is a lot of uncertainty over the monsoon. Now, already we have reports from various foreign meteorological departments saying that El Nino is forming, so the impact is going to be there. Similarly, what you will see, and actually, I think today also the IMD has put out another update which says that in June there'll be a slightly lower than average rainfall. So, this kind of uh, various pronouncements from the weather departments will keep coming. So, monsoon will become a very crucial factor which will determine how food prices and food inflation moves over the next few months. Because at the moment, we have inflation under control, it is within the RBI's comfort target band. But if food prices suddenly spike, then you might see the inflation picture going slightly haywire, and which is when the RBI might consider one or two more rate hikes if the situation so warrants. So, as far as debt investors are concerned, they need to be very clear that do not keep waiting. Already, you should start allocating whatever the money is and start locking into the higher yields based on your debt requirement, because the debt portion of the portfolio needs various maturities when you will need the money. So it's better to start allocating your long-term amounts and start locking into this aspect, because then even if there is a slightly uncertain environment, you just have a small part left to invest, which you can do later on.
Okay, so that's the advice coming in for all your debt investments right now. You can maybe start looking to lock it when it comes to the all those funds that are that have a higher yield. But at this point in time, Arnav, just wanted to know your take. How should an investor who is now looking to make a fresh entry should place their bets in when there's a difference between the equity as well as the debt? What kind of an exposure you would suggest an investor to have at this point in time? How much portion to be in equity, and which particular aspect to look out over there? And in the debt side, if you can suggest some of the names where an investor can go and invest.
So, see, there are two aspects to this. One is that every individual needs to do their own working in terms of what is going to be the debt equity mix in their asset allocation portfolio. This not only depends on what are their goals, what is the time period left, but also to the fact that how much of amounts that they will have for investing, and what is the kind of exact risk that they are able to take. So, once having fixed that, let us now focus on the fact that it doesn't matter in terms of what is the percentage here or there, because that will be different for everyone. But the key part is that what do you do within the range. So, for example, if we look at the debt side, you need to understand that there are various options in debt for different kinds of people. A senior citizen, for example, for them, this is a very big opportunity because two things have happened. One is that instruments like the senior citizen savings scheme, where they get a fixed rate of return plus the payout is quarterly, the limit for investment has been raised to 30 lakhs, which means that they can deploy more funds in this particular area. The other thing which has also happened is that because of the rate rise, you see that even all fixed income products, including fixed deposit with banks, the small savings schemes, including the senior citizen savings scheme, they have seen a rise in the returns that they are giving. So this is a good opportunity, for example, for senior citizens, and you can see that already in the month of April, I think some 10,000 crore has flowed into the senior citizen savings scheme. So that plus the tax aspect, because people should not forget the tax aspect, because that is a net return which they will get. So, for example, continuing with the senior citizens, one can see that they have a 50,000 rupee extra limit of deduction which they can get when they invest in deposits, fixed deposits. So they have to make use of this. Similarly, I mean, if you have someone else and who a young person who's looking at equity oriented portfolio, they do not have experience of the equity markets, they need to go towards equity mutual funds as a starting point, because this is the base on which they're going to build their entire foundation. And when they do this, They need to not just focus on the returns, what is going to be the highest earning fund going ahead. What they need to do is achieve a proper balance in their portfolio using a mixture of funds which cut across market caps. So if you take one approach and say have a large cap fund, a mid cap fund, a small cap fund, plus some other style of investing which could be value oriented, then you are creating a certain kind of portfolio. But in many cases, people are not so disciplined and they don't know how to allocate there. For them, see, there are flexi cap funds, there are multi cap funds wherein the fund manager actually ensures that there is this kind of distribution. So the options are good. You need to understand yourself and choose the way you are going about it, but do not take a singular approach and do not try and just look at one or two investments. Try and spread out your portfolio. That is the way in which this kind of exposure can be taken.
Okay, Arnav, and my last question to you at this point in time, you did share the outlook that you're having and the advice for all those equity as well as debt investors. But any of the suggestions, which are some of the, or any of the categories which you feel that some of the must have in the portfolio when it comes to the equity as well as the debt side of the investment?
So if you're looking at the debt sides, there are two types of goals which people have. One is that, I mean, you have very short-term goals or you want to put money away for a very short period of time. For that, obviously, you have liquid funds, ultra short-term funds, which will uh, suit your needs. If you have a longer-term outlook, if you know exactly when your goal is and you have a debt allocation for this, you have target maturity funds wherein you will get the money and you can have an exact idea of what is the kind of yield that you are locking into for this period of time. So that becomes a very crucial aspect. Even for other kinds of long-term funds, you have PSU banking and debt funds. You have some corporate bond funds which are there. So these allow you to build a debt portfolio also which suits your particular needs. Similarly, if you go to the equity side, and on the equity side, as I said before, that you should have a mixture of large, mid, and small cap funds in your portfolio. But if you are not able to do that, a multi-cap fund, for example, plays that role because by very definition, a multi-cap fund will have a minimum 25% exposure to large, mid, and small cap, with the remaining 25% in a floating zone, which the fund manager can decide on. So these kind of funds, if you are able to include in your portfolio, once you have them as your core portfolio, then you can look at other styles of investing. For example, there are a lot of value oriented funds which are there. There are contra funds which are there. These can be added later on, but the key part for an investor is to base the build of for your entire portfolio, and these can be done with these simple and basic funds which are around.
Okay, Arnav, with this we'll let you go on that. It was great having you on the channel to discuss about the outlook of the equity as well as the debt side of the investment. Thank you so much for joining us today on ET Now.
Thank you.